In our video with the two stock portfolio example, we showed that two stocks sometimes can give us less risk than either stock individually. And we said that was due to the idea of diversification. Don't put all your eggs in one basket. Well, if two stocks is better than one, is three stocks better than two? Is five stocks better than three? At what point do the benefits of diversification diminish and stop being useful? And that's something that we're going to try to address here in this video and introduce a couple different types of risk. When we talk about diversification, we can use a simple diagram. On the vertical axis, we have the standard deviation of the portfolio, or how risky that portfolio is. And on the horizontal axis, we have the number of securities in a portfolio. Now, in my example, I'm often going to use the word stocks when I talk about diversification, but securities is probably more appropriate because adding bonds or other types of investment to the mix can even help reduce our risk a little more than just focusing on stocks. But if we look at how many stocks, 5 is better than 3, 10 is better than 5, but notice what happens. We get a lot of risk reduction initially. The overall risk drops, but after a certain point in time, it kind of levels off and we don't see much more risk reduction. So where is this point right here where most of that risk is reduced? Maybe we haven't got rid of all of the risk, but the majority of the risk that we can get rid of is gone. And the answer is going to vary depending on who you're asked. Some people will say as few as 10 stocks are necessary. Other people say at least 100 stocks is necessary to get rid of most of the risk. But probably somewhere around 20 to 50 different stocks will get rid of most of our diversifiable risk. And again, you can even reduce that more if you think in terms of securities and not stocks, and maybe add some real estate, maybe add some precious metals like gold, add some bonds, get a broad mix of types of investments in there, and that's even going to do a better job of reducing that overall risk. But you can see that no matter how many securities you add to the portfolio, there's still some risk there. We can't eliminate all of that risk. So let's break this down into two parts. The first part is the risk that we can get rid of, this section up here, where we dropped all the way from this level of risk down to about here. That risk is sometimes called diversifiable risk, or other times it might be called firm-specific risk because it's tied into a specific company. For example, let's say that I own one stock. I've invested everything I own into Ford stock. And today I open up the newspaper and see that Ford is having a very large recall, and they're going to have to spend about $1 billion in recalling some cars and fixing something with them. What's that going to do to the price of the stock? Well, clearly it's $1 billion of unexpected expenses. That lowers the cash flows that are available to me as a stockholder, so the stock is going to become worth quite a bit less. Maybe Ford drops by 30 or 40% in the stock market today. As that's my only stock, I'm going to take a large hit. If I had $100,000 invested in that stock and it loses 30 or 40%, I'm going to lose $30,000 to $40,000. Now instead, let's assume that I had my $100,000 invested into 50 different stocks. So there were no more than $2,000 invested in each individual company. One of those is Ford. Ford makes that same announcement and drops by 30 to 40%. Let's say 40%. That would be a loss of $800. The rest of my portfolio is not going to be affected. Walmart's not going to be affected by a recall in Ford. Pepsi's not going to be affected by a recall in Ford. Apple is not going to be affected by a recall in Ford. So my other 49 stocks are doing just fine, and my total portfolio drops by about $800. It's hardly noticeable, and if a few of those stocks have a little bit better than expected news, they're going to totally offset the impact of that bad news by one of my holdings. So by having 20 to 50 different stocks in my portfolio, I've made it so the impact of Ford on my overall risk is tied just to that company, and I've eliminated that risk in my portfolio. However, notice that we still have this section of risk left. We never drop below this point here. So this risk is sometimes called non-diversifiable, are occasionally referred to as market risk, because even if we owned every stock in the financial markets, we'd still have that risk. So non-diversifiable or market risk is risk that cannot be eliminated even in a large portfolio. I gave the example of Ford as an example of firm-specific risk. As long as I own 50 stocks, that news on Ford is not going to have a very big impact on my overall portfolio value. But what happens if I turn on the news today and there's an announcement that GDP is falling much faster than anticipated? Maybe we were expecting that for this quarter GDP was supposed to go up by 2% and actually drop by 3%. GDP is income for the entire country, and so that's going to have a huge impact on every stock out there. If the economy is slowing that rapidly, all my stocks are going to get hurt. And what I might see is the overall stock market might drop by 10 or 20%. And even if I own 50 or 500 different stocks, I'm not going to be protected against that drop. There's no way to diversify against that risk because it affects every company out there. So when we talk about things like interest rates, our energy, our overall economic activity, maybe risk preferences, those things affect market risk. They're non-diversifiable, and no matter how many stocks we have in our portfolio, we can't get rid of them. From an investor's perspective, we now have 3 different types of risk to look at. This first risk, standard deviation, which we introduced earlier in this chapter, we can call total risk. Standard deviation includes both the firm-specific risk and the market risk. However, that's only important if we hold a non-diversified portfolio. If we're somewhere over here with 1 to 5, maybe 10 different stocks, then we want to worry about the total risk. If we own a well-diversified portfolio and we're out here with more than 50 stocks, this firm-specific risk is no longer important. So we don't care about the firm-specific and market risk combined of each stock. Instead, we just care about the market risk. And we can measure that market risk with a risk measurement called beta. And that's going to be the next thing we talk about is beta, what it is, how it measures risk, and how we can use that to determine what an appropriate rate of return should be on any particular stock. But the idea from this video is that we have a few major types of risk: total risk, firm-specific risk, and market risk. Firm-specific risk can be eliminated in large portfolios. So we want to focus on total risk if we have a non-diversified portfolio. We want to focus on market risk if we have well-diversified portfolios.